Okay, the last chapter that we're going to cover for this semester is GAAP 6. And what we're going to cover is how we use internal systems, which is basically operations within a company to maintain and manage our cash to make sure that our cash accounting is accurate and honest. So the first thing we're going to talk about is what's called internal control. Internal control means using things within the company that already exists. So what we want to figure out is how companies can use these systems and employees that they already have within the organization to keep accurate records. Doing this within the organization rather than hiring somebody else or doing it outside of the organization, it cuts costs because, again, you're already working with what you have, but it also improves efficiency and the timeliness of getting things done, especially when it comes to things like petty cash that we're going to talk about, and then these other small expenses. Um, Internal controls use accounting principles to make sure that the information is clear and accurate while being up to the expectations of the company. So, by using these internal controls, again, we are making sure that our business procedures are being followed, but also ensuring that what we're doing is accurate and legal within our cash accounting. So, this is stuff that's not required, but it's good to know, especially for those of you that are doing more of the finance stuff and not just accounting. The Sarbanes-Oxley Act, or SOX, was created to set up proper control system known as, I'm sure you've heard it before, as an audit. These audits are basically checkups to make sure that the records match up, your accounting records, your bank statements, and everything that match up so there's no fraudulent information. And that's whether that information is intentionally incorrect or not. So mistakes could cause audits to have something pop up. So there can be internal and external audits. External audits are when another company or like a government agency does this, and that's coming to prove transparency, or in certain legal situations where you have to prove your financial statements or things like that. So within these audits, you can find mistakes, and it's not always because somebody's committing fraud. It could be something as simple as human error and doing things accidentally. And while people are like, well, then get rid of human error by using AI or other technology, it's definitely being used on the front end to try to catch the things that are supposed to be easily caught at the beginning. But human control system of the technology and just as a checkup and checks and balances is definitely necessary. Okay, so let's get into what it is that we are actually talking about. And we've been talking about cash for 5 chapters, and we just need to make sure that we got to make sure we understand what it is that cash is going to be defined as. So it doesn't just mean like the stacks of bills that you have in your wallet or in your purse or whatever, but it's also things like checking accounts, certain bank accounts, and things that are known as cash equivalents. So cash equivalents are things that are quote cash like, meaning the value of what it is that you have in that asset can be reasonably estimated and easily turned into cash if needed. And how quickly something can be converted into cash and maintain that full value is liquidity. So something that is highly liquid means that it's more easily turned into cash while withholding its value. So this is kind of the most liquid to least liquid assets that we'll deal with. You don't need to know this order, but basically you just need to think about what is easiest to turn into cash, whether that's through sales or from liquidating assets, which is, again, the idea of getting rid of things and getting cash as quickly as possible. So, of course, your cash and bank accounts are readily convertible into cash, while something like inventory, fixed assets, and goodwill, either it's hard to value that idea, like how much is my goodwill worth, or something like a fixed asset is going to be tough to sell because it might be something that's super specific to your company, or it's something that you need, or it's something that doesn't hold its value very long, something like a car. All right, so going into what effective cash management is, we got to figure out how, as a company, as accountants, we can effectively manage our cash in the most kind of making sure that it's the most efficient way, but also making sure that we're using it to help improve the company when possible. So the first thing that you could do is get paid by your customers as soon as possible because you want to have that cash on hand. Because, like we know, cash is king. So you want to try to get the money that is owed to you as quickly as possible. So, like we've talked about, you offer discounts, you try to incentivize cash payments, or you provide penalty or you give penalties for people that are missing certain due dates. So those should try to get people to get you paid as quickly as possible. Now, number two says delay payment of liabilities. So, number one, we want people to pay us as quickly as possible. But number two, we want to pay people as late as we need to, because again, we want to keep that cash as long as we can. So we just try to pay when we needed. So, like when we see those 15 days to pay for a discount, we'll pay on that 15th day instead of just paying on day one. We want to keep that cash available just in case we need it, or just it's good to have in case of a rainy day. So then number three, keep only necessary levels of assets. So we're going to talk about what that means when I say idle cash. When I say idle cash, I'm talking about cash that you're just not really needing. And it's like an emergency fund for like your personal savings. But for a business, that idle cash, the stuff that we're not using, needs to be invested elsewhere. So that kind of goes into number four and number five. So when we understand what our cash levels are, we'll have to plan and budget those expenditures. So that lets us plan and figure out exactly what it is that we're going to be expecting to make to spend in the future, so that we can make sure that we have the proper cash on hand as well. And then after that, whatever we figure out is that really excess or overstock in cash, which is a good problem to have. That should be invested, whether that means stocks, bonds, reinvested into the company or anything like that. That's going to be up to you as the kind of the managerial accounting side, what to do with that extra money that we have. Okay, so getting back into this term petty cash, this video is linked below as well, so take a minute to watch it. It does a good idea of explaining what this idea of petty cash is, and it's just a good little example video to get you hearing a different voice than me, but also gets you to define what petty cash is, and it also starts to go into how we do the accounting stuff of that. So take a look at that. So you can pause this video and go to that one and then jump right back. Okay, so what we saw is petty cash is a small amount of cash. There's the textbook definition, kept on hand to cover minor incidental expenses. So how we use this at Elk Grove, each department has a small petty cash fund used for reimbursement for teaching activities or other expenses. So like if you had your intro to business and I was doing the taste test activity, I would use the district's petty cash account to pay for that, $75, $80, $100 worth of materials. So what petty cash is, they don't just give me money like we see. Petty cash requires reimbursements once we use it, and that always requires a source document, like we've been talking about. And a source document is something like a receipt, an invoice, or something that proof of payment. And that may or may not cover tax, but District 214 and some other institutions are what's called tax exempt. So we don't have to worry about paying that tax money. So another thing that you can do with petty cash is that they can be headed out on like work trips. If you've heard the word per diem, where it's like, you get $50 per day to spend on food and things like that, you can just give employees $50 of cash to spend, and that way you don't have to track it. And you want to try to hold them to that strict expense budget, so that anything extra than that is going to be on the employee. So petty cash is easier to use than literal cash, because using a company credit card or having the employee use their credit card, you have to fill out expense reports, you have to do a reimbursement process. It's just a timely process that's not really necessary. And since petty cash is really low transactions, usually under $100 at a time, it's easier to just do the cash payments. And then at times, like we'll see coming up, is that credit card fees can make things more expensive. So if we can just pay with cash to save some money, we'll absolutely try to do that. Okay, so like the video showed, we're going to actually get into what's called establishing that petty cash fund and setting it up. So the first thing we have to do is establish that petty cash fund, which basically just means putting cash from our company account into our petty cash account. So it's just reallocating where that money is. So what we do, petty cash is an asset account, so we want to increase that. So we debit the petty cash account for the full value. So in this case, we established a $250 petty cash fund. So we will debit petty cash for $250, and then we will credit just simple cash for $250. So even though the money stays within the organization, we just have to make sure we track it's going into the right place. So after we use petty cash, or whether it's a trip or whatever it is that we're using that cash for, um, petty cashiers need to then refill the account so that there's money left for the next person. Because if I use something and then Marshall wants to use something or another teacher wants to use something, they actually have to have that money available, because we're not just handing out credit cards, it's actual cash. So the cash has to be available there. So, in this example here, we need to replenish petty cash that was used to cover $45 of postage expenses and $25 of other miscellaneous expenses on January 31st. So again, rather than having somebody check out a company credit card, then doing this postage expense maybe at UPS or something like that, and then having to bring the receipt back, and then having to wait for the credit card statement to post and things like that. Here's just simple $45 of cash that you can use. So what we have to do is we have to increase our expenses because we did pay for expenses. We can't just say that the cash was used. We still have to say what we used them for. So we have to debit each expense individually. So postage expense and then miscellaneous expense. It's up to you to just kind of define what, as an organization, what miscellaneous expenses mean. But it could be something, that is not typical of like travel expenses, or in this case, like shipping expenses, something that doesn't really have a category. And then, because we need to put the cash back into the petty cash fund, we have to credit cash. Notice that we don't do anything to petty cash because that value has never actually changed. We didn't credit petty cash at any point. Okay, so here's a good spot for a break. So you can pause this and then we can just come back here as we continue on with the petty cash stuff. All right, so here's a couple examples of petty cash control systems and what it looks like, so that we've always keep talking about these source documents, and we always need to make sure that we have evidence. So this is an example of a voucher that people would use to request petty cash and then show that it has been handed out. So in this one, you can see that there's the date, you request the amount, who is getting the cash, so that again, we know who it is that the cash is going to, so we can keep track of it and who we should expect the cash to come back from. And then we see the for. So what is it that they're doing these petty cash transactions for? Is there a certain account that money comes from? And then who is it that is tracking that account? So here's an example. Again, nothing that you have to do here, but just an example of how each of these work. So stationery, postage, travel fares. So again, that's the type of expenses that you deal with. And then you see who it is that's paying them and then that total amount. So we're seeing how that's tracked and then how it is that we have to reimburse that account. So if you could go onto your note guide, do this best you can, establish a petty cash fund, and then reimburse it after those expenses have come in. Okay, so pretty simple, straightforward as far as establishing the petty cash account. So we just have to debit petty cash for the entire full amount, $350, and then we credit cash to set that account up. So then on January 31st, after we get the expenses, the receipts, and everything turned in, we have to list each of our individual expenses to continue to keep track of where the money is spent. And then we add them all together, and that is the amount of cash that you need to put back into the account to get it back up to $350. So in this case, we spent $95 from entertainment, travel, and miscellaneous expenses. So we have to put that back into the account to make it back up to $350. Okay, so the last thing I kind of talked about is your receipts are equaling what it is that you have to put back. Well, sometimes that is not always the case. So what happens if our receipts do not equal the amount of money that returned? It's not always, whoever the employee was stole that money and they were trying to grab a couple extra bucks here and there. It could be a simple mistake, like something like lost change or things like that. But because petty cash payments are usually so low, like we just saw a $45 or $15 expense, missing money is just kind of treated like an expense, or extra money, which could happen, is treated like a revenue. So when things do not equal, again, we're not trying to argue or fight with our employees because we're not going to fire them over a couple of missing dollars. So When things do not equal, there's a new account that's called cash over and short. Cash over and short will be used whether the amount is greater or less than the reported expenses. So we're either going to debit or credit it depending on what we need. So in this account, this example, we have to look at the submitted receipts to show that the employee spent either less, the same, or more than what we recorded. So in this case, the employee submitted receipts that showed they spent $75. So their travel expense, maybe it was something that they bought at a hotel or something like that, or gas, was $75. However, when we checked the books, it showed that we were actually $82 short, meaning that there's seven missing dollars that the employee did not account for. So rather than fighting the employee over those $7, we're just going to treat it like an expense. So since our expenses increase, we debit cash over and short, and then we credit cash for the entire $82 that we need to put back. So either way, whether the cash is there or not, we need to put that cash back into the petty cash account for that full amount to make sure, again, the entire amount is there for the next person. So after running the account for a while, you'll figure out, is there too much petty cash, not enough petty cash? Because again, cash sitting there that's not being used is wasted. So we want to make sure that we're using it to the best efficiency that we need. So if we want to increase the amount of petty cash that we have available for our employees, it's very, very simple. You just need to debit petty cash and credit cash for the amount you want to increase, not for the new total. So in this example here, we want to increase petty cash from $250 to $325. So again, the petty cash account already exists. It's already $250. So all we need to do is debit an extra $75 to get it from $250 to $325. So again, the petty cash account coming into January 31st was already $250. So now we just need to put in $75 more dollars. You can also decrease the petty cash fund if you need to. So you do that by just flipping it. So you would debit cash because you're taking your cash and putting it back into your cash account, and then you're taking that from your petty cash account. So if you wanted to go from $325 to $250, you would just flip this transaction, debit cash, credit petty cash. Okay, on your note guide, go ahead and look at number 14. Think logically, but if you have to do some research, answer the question, that's great. We'll talk about that as you need to. The question after that asks you to do a couple of petty cash transactions on your own. You can take a look at the answers of that as well. So let's take a look at this example here. So what we are seeing is an example where we are spending $150 worth to establish a petty cash account, and then we're going to reimburse it to make sure that everything is equaling out. So this is just an example here. There is no nowhere to put this in your note guide. It's just an example to get things started. Okay, so this is what we should do in our transactions. So the first thing, establishing, replenishing, and then increasing. So on January 1st, we established a $150 petty cash fund. So we just took cash from our cash account, credit, and debited it into our petty cash. On January 31st, we replenished. So again, each individual account we had to make sure that we accounted for. So the petty cash fund showed that $61.29 were remaining from that initial $150. So we were hoping that our expenses would equal $88.71. Unfortunately, what it turns out to is that our receipt showed we only spent $86.70. So that extra $2.01 has to come from that cash over and short. Now our last transaction is to debit petty cash for $100 because we're just increasing that petty cash account. So again, taking our amount that's already $150, we're increasing it by $100, so now it'll be $250. All right, there's going to be some more transactions in your packet. Take some time to go ahead and do this. This is reviews of everything that we've talked about up to this point in the semester, so take your time in doing that. All right, we are going to finish off with some little bonus stuff, some checks and bank reconciliation. So this is some stuff that I'm not going to test you on. but it is important to know, and it's stuff that you should do individually and as a company. So what we talk about is, what is a check? What's a bank reconciliation? What does that stuff mean? So first thing, checks are considered cash because they are highly liquid and connected to a company's checking account. So when you write a check to somebody, that's basically as good as handing over dollar bills. So checking transactions use cash, and even though checks may take some time to clear, they can have some errors. So a company wants to make sure that there's um, accurate information both on your side versus the bank side. So that's what's called a bank reconciliation, where you have to make sure that your bank account equals what your accounting statements say. So we're going to see what our bank statement versus our book balance is. So, a bank reconciliation is completed by a company to compare accounting books and bank statements. Your bank statements is what you see basically at the end of each month to track all withdrawals and deposit from an account. And then your business activities could continue after those statements are official. So, if your bank statement comes out on November 27th and you make some transactions on the 28th, 29th, or anything like that, they're not going to show up in your bank statement. So, you just have to make sure that. You have that accurate information included everywhere. So what you're trying to do is looking for inconsistent information and making sure that all money is accounted for. And that's not just a business thing, it's something that you should also do to make sure that your again money is being handled properly by you as well as your institution. So we're going to start this off by asking you to look at some parts of a check and then writing this. I know that checks aren't written very often anymore, but it is something that's good to know. So here's parts of a check: the payer, who the money is going to, the date that it's written, the amount, spelling out the amount here in actual words. So again, you're making sure that the number amount at the top match the number amount that you write. The memo line shows where that's for. So that's usually an invoice number, like homecoming tickets or whatever, and then you have to sign it. So the check is not completed until all this stuff is actually accounted for, signature, and everything's filled out. And then you got the bank number, checking a number, and then the account number down here, so you can track where the money is going to, where it's coming from, and then you can clarify that you understand which check went where. So on your note guide, if you want to just do a little bit of a practice run, your company paid an invoice, writing a check, go ahead and do that on your note guide. Okay, so to do a bank reconciliation, what you need is your most recent bank statement and your most updated accounting records or your ledger account balances. So we're looking again at two things: the bank statement, which is the bank's records of the company's account over a period of time, so November 1st to November 30th or something like that. So again, that's going to be tracking your cash accounts. Then you have your book balance, which is your internal records. So whatever your accountant or record keeper is doing to make sure that you're tracking the cash in and cash out. So what you need to do is you'll look at your discrepancies. I'll just put these all up here and talk about them kind of quickly as you can see each one. So you see that things may not equal out between your cash balance that your bank has and the cash balance that your accountant has. Again, that's not something that is usually done in on purpose or anything like that. It could just be the timeliness of the information or just putting a zero where there should have been a one or something like that. So on the left, it shows what adjustments you need to do to make sure that your bank statement equals your book statement. So the first thing is what is called a deposit in transit. So again, if I'm using an example of my bank statement shows on November 28th, but on November 27th or even November 29th, I went and deposited some checks. They haven't showed up in my bank account yet. So I have to know that my accounting records are going to show that I deposited that check, but my bank statement's not going to show that up yet. So I'm just going to have to go back to my bank statement and add that balance back in. So that's a deposit. You're adding that money to your bank statement. It'll eventually show up. So it's just a quick change. Then there's something called outstanding checks. So that check that you guys just wrote, as soon as you write that, you'll mark that in your accounting records that you paid that balance, but that check is not going to actually be taken from your account until it's deposited by the person that you pay. So this is like your grandma giving you a $10 check for your birthday, and then a week or a month later, she's like, "Hey, did you deposit that check yet?" It's because she's trying to track to make sure that money's been sent. So she wrote that check had been written for $10, but that $10 doesn't actually come out until you submit it. And then lastly, there could be some bank errors. So depending on what the bank error says, they might have accidentally credited something when they should have debited something. You just have to make sure that you're adding it or subtracting it based on that error. Now, from your side, when you're again looking at your company's balance, so this is what your cash ledger balance shows. So again, first thing we're going to look at is process deposits. So again, this is a company or a customer paying you for something, and then the money actually showed up. So you're putting that money into your book balance. Then interest earned on your checking account. So checking accounts do potentially earn some interest. So when they do that, you get paid that probably once per year. That's money that you get paid for letting the bank use your money. So you add that into your account. Then there's a non-sufficient funds check or NSF check. Basically, what that means is a customer paid you something that they owed you. So maybe it was a $2,000 payment. They wrote you a $2,000 check. You believe that you got that payment, but then you go to pay to deposit it at the bank, but the customer doesn't have that money available. Well, the bank can't give you that money then. So they return that check to you, so you don't actually get it. They return that check to the customer. So then you have to remove that money because you didn't actually earn it, and then you have to reestablish that accounts receivable from the customer again to make sure that they pay you. Then there's a bank service charge. Banks may charge you for using their service, maybe $75 a year or something like that. That's taken from your money. And then again, anything that you could have errors on your accounting side. These are just examples. Again, looking at it in a different way. I like these because it's just all looking at this just in a little bit of a different explanation. Okay, I'm going to put these up here, these bank reconciliation examples. Pause and look at these on your own time. I'm trying to be able to do this time here. So read each of these, do this, and I'll show you, and you can pause and look at these as each of these go. And here's another example, your bank statement versus your book statement, and then here's the transactions of the things that show up. So this is how you would make each of those changes on your bank statement. Bank balance, add and subtract those changes. Then you got your adjusted bank balance, and then you got your book balance, add or subtract whatever the errors or changes were there. And then you have making sure at the end, your bank balance equals your book balance. These are the transactions that show those changes. So cash earned because of interest, cash spent because of potential errors. Okay, finally, last thing for GAAP 6, then we're finished. This shows basically how long people owe you money for. What is it? What are the chances that I'm going to receive those? So this shows the likelihood of receiving payments as due dates are passed. So basically, what this shows is that the longer past the due date it is, the less likely you are to receive the full payment, if anything. So, like if I lent some of you money for lunch, and then I was like, "Hey, pay me back next week," and then next week you didn't pay me, and then 2 weeks go by, 3 weeks go by. At some certain point, I'm just going to assume I'm not going to get paid. So what this shows here is this: how much is our account receivable divided by our net sales. How long is it going to be that we are going to expect to receive our money, and how much of that money are we actually going to be receiving? So again, you want to do whatever it is as possible to receive that money as quickly, as soon as possible. So again, discounts, anything like that, to try to get employees or customers to pay as soon as possible. So that puts an end to GAAP 6. Hope that helps. Slideshow and note guide are attached in the video. Again, pause, rewind, and use this as much as you need to. Hope this was a good look into GAAP 6, petty cash, internal control systems, everything like that.